Technical analysis is very important in share market, stock market, and for MBA students. And today I am going to discuss about the technical analysis. So I am Sabita Lal. Hello everyone. Technical analysis is very important in investment management. And in investment management, when we are talking about here, two type of analysis is there: technical analysis and fundamental analysis. Fundamental analysis I discussed about the company analysis and industrial analysis in the previous PPT in previous presentation. So today I am going to discuss about technical analysis. In the technical analysis, the outline is what is technical analysis principle and assumptions, charting analysis, technical indicators, technical trading rules, and evaluation of technical analysis. Technical analysis, in this book of technical analysis explained, Martin J. explained the technical analysis approach to investing is essentially a reflection of the idea that price moves in trends which are determined by you're changing the attitude of investors towards a variety of economic, monetary, political, psychological forces. The art of technical analysis for it is an art. It is to identify the trend changes at an early stage and maintain the investor's posture until the weight of the evidence indicate that the trend has been reversed. Because like the share market, how it works, stock market. Like for example, Nifty is now in 22,397, it's yesterday's. So the market will go upward, downward, or sideways. How we will analyze? So based on many analysts gave their theories, Michael Doe gave how it will work. Then we EMH approach was there. Then we have a many thinking like bar chart, line chart. Then how you will do with RSI index, and many more analysis was there. So technical analysis, because fundamental analysis says that what is based on your company's behavior, how it was ROI, P ratio, all that book value. And the technical analysis is totally depend on your chart. The movement will depend on your chart. So the trader, analyst, and investors have used technical analysis for centuries and achieved the broad acceptance among the regulators and academic communities, particularly with regard its behavioral and financial aspect. Like if I want to know the brief overview of the field, compare technical analysis and other school of analysis that describe some of the main tool used in technical analysis. So although technical analysis follows the predefined rules and principle, the interpretation of result is रेगुलर मीन्स जनरली सब्जेक्टिव, क्योंकि हमें पता चलता है कि मार्केट कैसा मूव करेगा बेस्ड ऑन द न्यूज, हाउ that technical, that bar graph and all opening, where it will close, it will change. So this is also certain aspect such as the calculation of our indicator, follow specific rules and interpretation of finding often based on your melding and the techniques. So what style you want? So as the approach of the individual analyst, in this respect, technical analysis is similar to the fundamental analysis, which has specific rules for calculating the ratios. So, but for example, but introduce the increase whatever you have subjectivity in the evaluation phases, the technical analysis principle and assumptions. The technical analysis generally they have basically three main you assumptions. That is, the first one is market discount everything. What it means, you only the consider the price movement and ignore the fundamental factor. Like if the news suddenly came in the market and how the market will be uptrend, if it is a positive news, if the negative news, how the market will be the with the basis of the sentiment, it will be what, going downwards. So only the consider price movement, ignore fundamental factor. Then second, assume stock price reflects everything. And the third, all fundamental are priced into the stock. The second one is price moves in trend. Here, price movement are assumed to follow a particular trend. If the good news or very positive news, market will go uptrend. If the something suddenly happen and the market will come downward, so it will be a downward trend. the no news and there is no more volume in the market, so market will be in the sideways. So that is a price moves in trend. So price movement are assumed to follow a particular trend, and the most technical strategies are based on the these assumptions. Then history trends to repeat itself. Market participants provide consistent reaction to similar market stimuli over the time, because I know okay, this market touches, this is my support and this is my resistance. So market will, if it will vary in this between support and resistance level, so how I have to perform and how I have to find out my strategy, what kind of strategy I have to follow. So that's why we can say the history trends repeat itself. Basic premises of technical analysis is your barring minor deviation, stock price trend to move in fairly persistent trend, and the shift in demand and supply bring about the changes in trend. And irrespective of why they occur, shift in demand and supply can detected in the charts. So this is the assumption of technical analysis is very important. Then again, if I am talking about, because I told already we finished the fundamental, because in investment analysis we have two types. Fundamental analysis first we should know, in that you have company analysis and you have industry analysis. Because in one industry, for example, it is automobile industry, under that how many companies are coming, Tata Motors is there, Ashok Leyland is there, how they are performing, Maruti is there, so how they are performing based on their P ratio, price book value ratio, what is now their NPS, EPS, so that all things will decide by the fundamental analysis. So and technical analysis is purely, it is a chart base and how the market follow the trend. For that we have to follow basically two theory, that is for Dow's theory, and EMH also we are following. And the bar chart, pie chart, RSI index, Stregel, Stengel, all that we are making strategies in the technical analysis. So here the technical analysis and fundamental analysis. Technical analysis shows the predict short-term price movement, but the fundamental establish the long term values. Like for example, if I know okay, the semiconductor will move in now next many years, so I will see the semi what are the who all the company who's making the semiconductor they are doing. So for that I have to do the fundamental analysis ki now what is their book ratio, it is more than, now market is performing now more than book ratio or less than their book ratio, and how what is the PE ratio. Based on that I will try for the long term. If I want to plan, I have to see their fundamental analysis. Technical analysis is the for the short term price movement. I know okay, this is a news, now market will react like this is my support and resistance level, so I have to make it. Second, focus on say internal market data, because whatever we know the market is movement based on their internal news. And fundamental analysis focus on fundamental factors. Then technical analysis is for to short term traders, but fundamental analysis is for long term investors. There is a very important difference for technical analysis and fundamental analysis. Charting techniques. I have here what Dow's theory, then bar and line chart, point and figure chart, moving average. It is a your 20 DEMA, 50 DEMA, 100 DEMA. These all the moving average analysis, and RSI index, that is your relative strength analysis. Now I'm going to discuss first is your Dow theory. The basic concept underlying the chart is your concept underlying the chart analysis is price movement is persistence, volume and trend go in hand, and there is respective support and resistance level. Now this is a Dow's theory. Michael Dow was a very famous, and he's from US, and first he was a journalist. What Dow theory? So Dow first they explain ki the market moves, and that happen here the three movements all going at the same time. डो ने बोला कि मार्केट सेंटिमेंट पे चलता है, इधर इट इज अप ट्रेंड जाएगा, मार्केट डाउन ट्रेंड जाएगा और साइडवेज जाएगा, दैट इज ऑल डिपेंड ऑन योर इंटरनल न्यूज फैक्टर. So that's why it's going at the same time. It is a daily fluctuation, random day to day, secondary movement, and correction at least the week or a month. And prime trends means respective all bull and bear phases of the market. So here the Dow theory on stock price movement is formed of technical analysis in the starting. Dow theory was derived from 255 Wall Street Journal editorial written by the Charles H. Dow. He was a journalist and the founder of the first editor of the Wall Street Journal, and the co-founder of Dow Jones and Company. Now you heard about Dow Jones. Dow Jones is name given based on his name only, Dow. And the Dow theory is a very important and the old theory that if we are following in the stock market. So the what is the hypothesis in that? Dow theory is based on the hypothesis that the stock market does not perform on a random basis. Rather, it is guided by some specific trends. So he told that there the type of specific trends has been a name in Dow theory, and that he told the market runs in a three ways, that is your primary trend means upward, secondary trend, and the minor trend means upward, downward, and sideways. So the primary trends based on your primary movement or the major trend may last from less than a year to several years. Can be a bullish or bearish. The secondary trend is based on the major trend the last from less than year to again several year. It can be again bullish or bearish. Then again the minor trend, it is a day-to-day trend or movement in price over few days, and it is a very short duration. So based on that he told about, I just discussed what is the upward or primary trend, downward trend, that is again primary trend, and upward primary trend. So he make like the time ki how the closing price will affect with the time in the secondary market. The basic assumptions of Dawes theory is market price determined by based on your demand and supply. Ki how many want that, because if I know ki Maruti share will touch now 11,500, now maybe it is in 11,300 and 400, it is fluctuating. So based on if some news suddenly it will come, whatever the quarterly result, or maybe they gave more dividend to their customer, whatever has happened, a new product launch in the market and the price will be high, whatever, based on that, maybe the market determine if the demand will be more, and we'll see the what is the supply. So market will base the first demand by the determined by the demand and supply force. Then price moves in a trend for long period, and reversal or shift in price trend may occur, and the chart graph can predict the change in demand and supply force, because suddenly we are telling ki now in market supply came means what happened suddenly, if the market comes down because many people are selling their shares, so market comes down. Suddenly some good news came and we are saying the demand is more, so sometimes the premium will be high. So that is the thing ki chart and graph suddenly will change based on the technical analysis, whatever the news come, and it is for the short duration, the market will change their nature. Then because that's why we are telling the market is supreme and we have to follow the market. So and the price trend pattern trend to repeat themselves. Now next will be your price chart. Price chart is always based on your like what is my today's opening price. For example, if I am talking about now Tata Steel. Tata Steel now from past 2 months, it's performing good. 2-3 months, the value of one share of Tata Steel was like near about 135 something. Now yesterday it's closed in 155.15 or something. So why the steel market is performing? What is the reason of in that metal? So yesterday's was means the opening, maybe if it is like 145 and the closing price was 155, so highest was 155 and the lowest was 146 or 147, whatever and the opening price is different. So the price chart we are seeing based on what is today's opening, what is the yesterday's closing, what is the today's high price, and what is the today's low price. So price chart talk about, if you will see any one particular stock you see, and you see the what is the today's opening price, so they will say that okay, this is the yesterday's closing price, and what is the highest price and the what is the lowest price of the today when the market will close. So you are able to know and you will get the idea ki what is the price movement. Bar and line chart. The bar chart depict the daily prices, just I told, the price change along with the closing price. This is a popular technique of showing the price variation and volume on a particular day. Like yesterday, share market opened first time Saturday, they work for 2 hours. So then what was the change happened? I am talking about that only about the Tata, about your Maruti as well as about your Tata Steel. So the chart is made of a series of vertical lines and represent each data point. The vertical lines represent the high and low for the trading period along with the closing price. So if anyone will ask you what is your Tata Motors opening price, closing price yesterday's, and what was the closing price, opening price, highest and the lowest value. So we have to see, and it will be written ki this was the today's opening price, it is the closing price, it is the highest and it is the lowest, and it is the previous day closing. So the closing and open are represented on the vertical line by a horizontal dash. Technical analysis believe that certain formation or pattern observed on the bar chart and or line chart has predictive value. For example, in the head and shoulder pattern, how it will move in the represent the bearish development, how the W will form, how the M will form. So what it the meaning? So the line chart shows the line connecting successive closing prices, and the line chart represent any variable over a set period of time. We have to decide ki okay, I need for 5 days or 1 week chart or 1 month chart or 5 years chart. So the line is formed by connecting value of represented variable over the time frame. Line chart do not provide visual information of the trading range for a like individual points such as the high, low, and opening prices and closing prices. They depict any variable like volume of security, index number, and price, etc. They were talking about. Now, point and figure chart, more complex than the bar chart. Point and figure chart, we can say it is PFC condenses the recording of the price changes by eliminating the time scale and small changes. The point and figure chart is not well known and used average investors, but it has a long history of using the dating back to the first technical traders. This type of chart reflects price movement and it not concerned about the time and volume in the information of the points. In order to prepare this type of graph, the analyst has to decide as to what is the significant price changes. RSI index. RSI index is very important and very popular. RSI index strength is based on the assumptions of price and the price, and it's followed during the bear phases in the relating to the market as a whole. RSI index, if you see ki how it will work, so in that you have to think about ki why RSI is important. RSI RSI index is indicator is very important. Why? Because we should know about the movement, like the technical indicator or and use the momentum trading. If the market will be like some good news will come, how the price movement is going upward. So that is the momentum of the market in the trading, and the measure the speed and your magnitude of the security recent price changes ki like what is the upward, what is the downward. So RSI index is very important and we have to use this one as the formula because we can say it is a momentum indicator. RSI index is nothing but and index is what it is, your momentum indicator in use technical analysis, because RSI measures the speed and magnitude of the security recent price. What recent price means, what is the today's present price, the changes to evaluate it is a overvalued or your undervalued condition in the price. So RSI is very, because I know okay, this stock is overpriced and this stock is underpriced. So if we say okay, it is undervalued, okay, I have to buy because maybe in next few months it will be grow, so that's why this is a momentum indicator. We can say it is a RSI index because it shows about your price momentum of the security. We can think about ki okay, the price will be overvalued or undervalued of the security, and RSI index it is display as a like oscillator, and the scale will be 0 to 100. If you will see in the technical analysis, if you go and see in any website, and so you see there the ki how the RSI index you type, you will get that ki it is an oscillator, it varies into 0 to 100. The indicator was actually developed by I think Mr. J Wells, so and in 1978. So it will only will talk about overvalued or undervalued securities or overbought and oversold securities. It can also indicate security may be prime the trend for the reversal, and after the correction it will be the pullback in the price. So RSI reading is 70 or above indicate it is a overbought situation. Please note down, this is very important because I told RSI oscillator varies between 0 to 100. So if the RSI trading of 70 or above indicates on overbought situation, and a reading of 30 or below indicates an oversold condition. So very important. The more than 60 means it is already overbought. So that time you should not buy that stock. And if it is reading will be 30 or below, that time it is oversold condition. So the good will be you have to see that it will be if it is 40 to 650, that time we will see, okay, this is RSI. We can think about we have to buy, or so it will be inform your momentum price. If the security is oversold or overbought or undervalued or overvalued. So the RSI, why I am forcing that, because RSI is a very popular momentum price indicator introduced in 1978. RSI indicator is a technical trader with signal of bullish or bearish price movement. That is it says, and it will be say that if it is a overbought when the RSI index is above 70, and when it is a oversold when it is below 30. So RSI line crossing below the oversold overbought line and the oversold line seen by the trader as a signal of buy or sell. If I will see it is crossing the 70, I have to sell. If I will see it is a over, because it is already oversold, overbought. And if it is oversold means it is below 30. So it will give the signal we have to buy or sell the stock. So RSI works best in trading range rather than your trading market. So RSI we are only focusing we should know the security will be oversold or overbought position. So this is very important, RSI index. Advanced decline line. We can say it is an advanced decline line is going down or upward. So the advanced decline line is also referred to as the breadth of the market. It measures, again involve two steps to calculate the net advances decline on the daily basis. What is the net your advance, like how many, what is the demand, what is the supply. So all that is very important in that, and obtain the breadth of the market by calculating daily net advance and decline. So that is also equally important. Now next will be new high and low. Technical analysis consider the market as bullish when the significant number of the stock hit the 52 high each day. Like for example, our Nifty reaches now 2 days before, day before yesterday, it is again new 52 week wise. That is it 22,338 something. So on other hand, if the market indicates rise, but few stocks hit new highs, technical analysis view is the sign of trouble. Volume, we can say now today's what is the volume in the market, it's like 50 lakhs or whatever, how many people. So based on that the option premium will be go high or low. So volume analysis is important part of technical analysis, other than being a equal or high trading volume is considered in the bullish sign. So if heavy volume are accompanied by the rising the price, is considered even bullish. Short interest ratio, the short interest ratio is defined as your what, how you have to calculate this, correct? So the total number of shares sold short by average daily trading volume, because it if you will like if you I am having zero the, so if the kite, if you will go and if you will see that like in a particular stock, if you will click and if you want to see ki what is their fundamental and what is their technical analysis, there you will get the particular stock here today this is the trading volume, and what is the sales short position, everything you are able to get it from there. So the short interest ratio is defined as the total number of shares sold short by average trading daily trading volume. Technical analysts consider a high short interest ratio as a sign of bullishness. This is very important. If you want to see about the market, you have to see about the short interest ratio is what. Short interest ratio means a sign of bullishness. Mutual fund liquidity. The low mutual fund liquidity considered as bearish factor, and the high mutual fund liquidity considered as bullish indicator. Put call ratio. Generally, you heard about what is the put call ratio. It is one in PCR. That we can other name it is put call ratio is your PCR. PCR is high or PCR is low. If PCR is below one, what is the impact? When PCR is more than one, what is the impact? So PCR ratio is what? Number of put purchase divided by number of call purchase. What is call? When we think that the market will go high, we will buy the stock option, that is a call. Call means you are buying, and the put means you are selling. You're thinking that the market will come down, so that is time you are buying a put. So call and put is that. So what is number of put purchase by number of call purchase? So a rise in the put call ratio is a buy signal. If it is, and if it is a fall in put call ratio is a sell signal. So put call ratio is very important. Prince statistic. Prince, whatever your volume declining by number of declining, and the formula is there, and volume advancing by number advancing. So the trend measure the ratio of average volume in declining issue to average volume in advancing issues. Generally a trend ratio of more than one demand bearish, and it means that the declining stock have higher average volume compared to advancing stocks, so suggesting in net selling pressure. Testing technical trading rules. Does the trading rule produce excess return after adjusting for risk? This is a question. Does the trading rules produce excess return after adjusting for transaction and other cost like taxes? Whatever your short term gain, long term gain, taxes, whatever we are paying, how consistent is the performance of trading rules? Is the trading rules valid outside the sample? So I discussed today about the technical analysis and fundamental analysis, how technical analysis is different from fundamental analysis, how Michael does what it says, and how RSI I force in these two things. We should know about that. And remaining your bar chart, line graph, all that is there. But in this video, I am trying to make it very important things. Like you should know about that, and you are able to write, because many times the questions for MBA students, Mcom students, or CFA students based on the technical analysis, they were asking these questions. Please explain the Dow's theory and how Michael Dow, what are the assumptions, how it will be help, and how the chart will be reflecting. Same thing about the RSI index, how it works, and how EMH theory. Next video I'll come with the EMH theory, efficient market hypothesis. So how it works, separate video I will make after this video. So I am summing up the session, and in this what we discussed about, like technical analysts behave that the trend pattern persist, and enhanced analysis of past market data can be used to predict our future price behavior. Second, technical analysis is the form of security analysis that uses price data and volume data, typically displayed graphically in charts. And the chart are analyzed by using the various indicators to make investment recommendations. Technical analysis use a variety of charting techniques that we already discussed. And the most popular one seems the Michael-Dow theory, bar and line chart, point and figure chart, how the moving average 50-day MA, 20-day MA, 100-day MA will work, and what is your RSI. The popular breadth indicator of the short interest ratio, how the short interest ratio will decide ki you have to buy or sell, how the mutual fund liquidity will come down, and also how we can decide put call ratio, how the put purchase and call ratio will decide ki how will buy or sell. Statistic. Technical analysts appear to the highly controversial approach to security analysis because it has what ardent voluntaries as will serve the crisis. The technical analysis use certain indicator, that is your breadth indicator, market segment indicators to gauge the overall market situation. So technical analysis is very important. So when you will learn investment management paper, you have the starting point is your fundamental and technical analysis. The remaining thing is there ki how you are doing mean median, and how you are buying the decision tree, standard deviation method, ki how you are finding the risk and return. All that is there after. This is the most important part. So thank you for watching my video. If you like my video, subscribe and share. Thank you so much.